owning a home is part of the American dream. In the U.S., home ownership is the major road for wealth building and economic opportunity. Many of the financial challenges facing our nation, the racial wealth gap, the home ownership divide, and inequities in credit access have their origins in a decades-old housing policy known as redlining. Only a few decades ago, neighborhoods and people of color were prevented from access to low-cost government and other mainstream loans. In the 1930s, the Homeowners Loan Corporation used blatant discriminatory rating systems and residential security maps that outline areas in red to determine communities of color to be high risk and therefore not eligible for conventional loans. The Federal Housing Authority and the Veterans Administration continued this policy of discrimination into the 1950s. The passage of the Federal Fair Housing Act of 1968 improved conditions, but federal regulatory agencies did not acknowledge their enforcement responsibilities under the Act until the mid-1970s. This history of lending discrimination with no access to mainstream lenders relegated consumers of color to borrow from fringe lenders paying much more for loans than they would have otherwise.
In fact, researchers just released a very important critical report the other day about the impact of legacy discriminatory issues on communities and consumers in Chicago. And what they found is that in just a 20-year span in Chicago, because of discriminatory race-based legacy policies, consumers in Chicago lost between $3.2 billion and $4 billion in wealth. These policies still impact us today because of their exploitative nature, have depleted wealth from the African American community. It's one of the reasons why today the African American homeownership rate is still declining. So we can show a direct linkage to the ever declining homeownership rate among African Americans today to those discriminatory policies that were implemented 30, 40, 50 years ago.
Wealth inequalities have, of course, grown substantially in recent decades, particularly at times of crisis, such as the foreclosure crisis of 2008 and the COVID-19 pandemic.
There have been many instances when private actors like civil rights organizations and fair housing organizations have had to take the lead in advancing fair housing and advancing fair lending. Oftentimes the government is acting in a way that is at cross purposes to the advancement of fair housing and fair lending. Perfect example, in the aftermath of the foreclosure crisis, the federal regulator for Fannie Mae and Freddie Mac authorized these two GSEs to place surcharges on consumers based on their loan-to-value ratio and based on their credit score.
Another impact from legacy discriminatory policies resulted in a dual credit market. Consumers with little to no access to traditional financial products were sought out and serviced by non-traditional lenders. Loans taken out with non-traditional lenders would set off a downward spiral that made consumers more likely to be credit invisible and have lower credit scores. Almost 30% of African American and Latino consumers are credit invisible.
Credit scores, much like automated underwriting systems that many lenders use, automated underwriting systems are also used by the GSEs, by Fannie Mae and Freddie Mac. So all of these systems, credit scoring systems, etc., they're built on the data that is housed within our credit repositories. The data that is housed in our credit repositories is data that is gleaned from the sort of mainstream financial markets. And one of the problems that we see there is that because America has a dual credit market, so we have One side of the market that is the mainstream financial market, that's where your banks and your credit unions are operating. But then we have a sort of fringe side of the market, an underbelly of the financial market, if you will. And that fringe market, that's where your payday lenders and your check cashers and your buy here, pay here lenders and the like, that's where they operate. So we have this dual bifurcated credit market. The problem that we have is that communities of color, for the entirety of U.S. history through today, are primarily serviced by that fringe market. And white consumers are primarily serviced by the mainstream market. That mainstream market, when you're accessing credit there, it's wealth building, it's healthy credit, it's safe credit, because that's a highly regulated marketplace. The fringe market is not regulated. In fact, some of those financial providers, some of those creditors aren't regulated at all. And so what we see is this dynamic where if you're accessing credit from the mainstream market, when you're accessing credit and you're paying your bill on time, that positive information is reported to the credit repositories. And so as a consumer, your activity, your sort of financial footprint is visible to other creditors who want to look at you and see, well, how good are you? Now these fringe lenders, for the most part, do not report positive information to the credit repositories. So if you're accessing credit in that fringe market, you are what we call credit invisible. It's one of the reasons why people of color, people with disabilities, single female-headed households, it's one of the reasons why these consumers are disproportionately credit invisible, because their footprint can't be seen by sort of the financial markets, right? Because these creditors are not reporting positive information to the credit repositories. Now, in a perverse arrangement, if you don't pay your bill on time and you're accessing credit in the fringe market, and you go to a collector, right? You go into delinquency, that negative information is reported to the credit repositories. So it's a very perverse arrangement. It's an arrangement that does not benefit borrowers, and it disproportionately negatively affects consumers of color.
While conventional wisdom would assert that modern technology would override attempts at biased credit scoring, automated underwriting makes the manifestation of racial biases and inequality easier.
So in order to develop an artificial intelligence system, you have to train it, you have to educate it, meaning you have to feed it data. One of the problems we have because of our discriminatory history and because discrimination has been so replete throughout the marketplace, both gender-based discrimination, discrimination against people with disabilities, discrimination against people of color, it has been so replete throughout the marketplace. Every single bit of data in our financial system, if you can think of it, the way I like to describe it is there's a patina of racism and sexism overladen. It's covering every piece of data. And so what you have to do is you have to build technology based on clean data, which means you've got to clean up the data somehow, or somehow in that algorithmic formula you have to correct against the discrimination that is inherent in the marketplace. Researchers at Berkeley did a study in which they analyzed loan records. So these are all loans that were accepted by Fannie Mae and Freddie Mac, because Fannie Mae and Freddie Mac have very uniform underwriting guidelines. They have this uniform pricing grid. They were using the same underwriting criteria, the same pricing criteria. And what the researchers found is that these algorithms were discriminating against people of color. So African Americans and Latinos who had the same financial criteria as their white counterparts in this lending pool were being overcharged. Why? because the algorithm is attuned to optimize profit. And if the algorithm is sensing, well, for these other loan products, you have paid more than what your commensurate level of risk is displaying, then you'll pay more for our mortgage loan. But the algorithm isn't designed to say, well, no, maybe you paid more for that auto loan because you were discriminated against. These systems haven't been trained to understand how discrimination is manifest in our marketplace.
The National Fair Housing Alliance promotes policies such as expanded credit access in the financial mainstream for people of color, single women households, and those with disabilities with mainstream regulated lending institutions to ensure the benefit of the consumer and society. The Racial Wealth Gap and Legacy Discrimination Program was produced by Channel 16 in cooperation with the Office of Human Rights and Equity Programs. The Office of Human Rights and Equity Programs receives and investigates complaints filed by any person who believes they have been discriminated against in Fairfax County on the basis of race, color, sex, religion, national origin, marital status, age, familial status, or disability in the areas of employment, housing, public accommodations, private education, and credit. For more information or to file a complaint, visit their website or call 703-324-2953, TTY 711.